Good day, everyone. My name is Derek Young, and I'm happy to be addressing you as a board member of Japan's Investment Trust Association. The association has asked a number of leaders of fund management companies to address the unsettling environment caused by the coronavirus, and I would like to share with you some thoughts on investing based on my years as a portfolio manager and as an executive in this industry. But first, please let me extend my profound sympathy to those who have contracted the coronavirus or who have loved ones who may be suffering. Our thoughts and prayers go out to all the citizens of Japan as the country grapples with this very trying outbreak. We all hope that the coronavirus is brought under control so that people can return to their normal lives. In the meantime, however, please be careful. Earlier in my career as a portfolio manager in 2008, I encountered an event that shook the markets the same way that coronavirus is affecting them today. Following the collapse of Lehman Brothers, the Dow Jones index of U.S. stocks plunged more than 50%, and along with it, many other assets also lost a substantial amount of value in a matter of months. As an investment professional, I understood the relationship between market risk and market volatility. The fact that prices of publicly listed securities will fluctuate as the market determines a price for a stock or a bond. But to determine prices, the market needs both buyers and sellers. And when a crisis hits, the buyers tend to wait until the volatility subsides, while sellers sometimes panic and dump securities at the wrong time. The fact is, the buyers will come back. But when they will re-enter the market is something that is very hard to predict. One factor that gives support to the market and therefore encourages buyers to come back is government-led action in the form of central bank intervention. Actually, before I was a portfolio manager, I spent the early part of my career working at the U.S. Federal Reserve Board in Washington, D.C., under the legendary Alan Greenspan. What I learned in those days is that central banks are prepared to step in to calm markets when volatility spikes and buyers flee. They do this by cutting interest rates to make borrowing more affordable and by stepping in as buyers of assets like stocks and bonds. In fact, that's what happened after the collapse of Lehman Brothers, when central banks around the world worked together to reinsure investors that over time, calm would prevail, economic growth would be restored, and markets would function properly again. So during this current bout of volatility, I remain confident that central banks will play their role until the situation becomes calmer and buyers return to the market. When that will be, we don't know. But after every market crisis that has happened so far, economies have recovered, companies have prospered, and buyers and sellers have made markets work again for investors. It's easy to say, just stay calm, things will be all right. But I know how scary it can be to see the value of your investments rise and fall in a short time span. Just like many of you, I too am an investor, and I have the same kinds of worries as anyone else. But I always try to keep a few things in mind regardless of the investing environment. Some basic principles for all investors at all times. Number one, understand volatility. As I mentioned earlier, as the market works to determine prices for publicly traded securities, there will be times when events happen that make buyers hesitant and sellers panic. As long as you understand that this is a normal dynamic in markets, it might help make these circumstances more digestible. Number two, diversify your holdings. There's an old saying in the United States, don't put all your eggs in one basket. If a farmer puts all the eggs from the hen house in one basket and then he accidentally drops the basket, the eggs break. But if you put a few eggs into several baskets, then even if you drop one of them, all the other eggs will be fine. It's the same in investing. If you build a portfolio of different assets like stocks and bonds, that are spread across different geographies, then it should help smooth returns over time. Number 3, stay in the market. As some investment professionals say, I might not be able to make money for you all the time, but I do know one way not to make money in investing, and that's by not being in the market. Research shows that if an investor was out of the market for only 10 days when returns were the strongest over a 20-year period, their return would be cut in half. Of course, in times like these, it might seem best to take a break and let the markets calm down a little. But the problem is that we really don't know when things are going to bottom out. Number 4, risk is usually rewarded over the long term. Investors these days have access to a world of opportunities, all of which present different risk and return profiles. Some investments offer lower risk than others, such as government bonds, but along with lower risk also comes lower returns. Before investing, of course, everyone should have a clear plan that includes an estimate of how much investment income they require over time and a realistic time plan for achieving it. Oftentimes, people find that taking a reasonable amount of risk by investing in equities over a long time span helps them achieve their goals. Number 5, market corrections often present a good time to enter the market. In the current volatile market environment, it's very hard to know when the bottom will appear. And I don't think any investors, professionals, or individuals alike should try to time the market. At the same time, when markets sell off the way we have seen recently, no doubt there are some good entry points. A conservative approach is to divide up your investment into several investment pools and put a little bit of it into work regularly, say on a monthly basis. Finally, I would like to echo the good advice that the leaders of some other fund management companies have been providing through this video series. And even though my Japanese is a work in progress, there are 3 words that I would like to leave you with. Choiki, Bonsun, Sumitate. In English, these are long-term, diversified accumulation. Regardless of language or country or experience as an investor, those are 3 very wise words to keep in mind at all times. Thank you very much, and I wish you all the best.